Hi guys! Welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about how to use leverage to amplify earnings and how to manage it prudently. So make sure to watch the full video. Company needs financial capital to operate its business. For most companies, financial capital is raised by issuing debt securities and by selling common stock. The amount of debt and equity that makes up a company's capital structure has many risk and return implications. Therefore, corporate management must use a thorough and prudent process for establishing a company's target capital structure. The capital structure is how a firm finances its operations and growth by using different sources of funds. Financial leverage is the extent to which fixed income securities and preferred stock are used in a company's capital structure. Financial leverage has value due to the interest tax shield that is afforded by the U.S. corporate income tax law. 1. The use of financial leverage also has value when the assets that are purchased with the debt capital earn more than the cost of the debt that was used to finance them. Under both of these circumstances, the use of financial leverage increases the company's profits. With that said, if the company does not have sufficient taxable income to shield, or if its operating profits are below a critical value, financial leverage will reduce equity value and thus reduce the value of the company. Given the importance of a company's capital structure, the first step in the capital decision-making process is for the management of a company to decide how much external capital it will need to raise to operate its business. Once this amount is determined, management needs to examine the financial markets to determine the terms in which the company can raise capital. This step is crucial to the process because the market environment may curtail the ability of the company to issue debt securities or common stock at an attractive level or cost. With that said, once these questions have been answered, the management of a company can design the appropriate capital structure policy and construct a package of financial instruments that need to be sold to investors. By following this systematic process, management's financing decision should be implemented according to its long-run strategic plan and how it wants to grow the company over time. The use of financial leverage varies greatly by industry and by the business sector. There are many industry sectors in which companies operate with a high degree of financial leverage. Retail stores, airlines, grocery stores, utility companies, and banking institutions are classic examples. Unfortunately, the excessive use of financial leverage by many companies in these sectors. The study of a company's optimal capital structure dates back to 1958, when Franco Modigliani and Merton Miller published their Nobel Prize-winning work, The Cost of Capital, Corporation Finance, and the Theory of Investment. 7. As an important premise of their work, Modigliani and Miller illustrated that under conditions where corporate income taxes and distress costs are not present in the business environment, the use of financial leverage does not affect the value of the company. 8. This view, known as the irrelevance proposition theorem, is one of the most important pieces of academic theory ever published. Unfortunately, the irrelevance theorem, like most Nobel Prize-winning works in economics, requires some impractical assumptions that need to be accepted to apply the theory in a real-world environment. In recognition of this problem, Modigliani and Miller expanded their irrelevance proposition theorem to include the impact of corporate income taxes and the potential impact of distress cost for purposes of determining the optimal capital structure for a company. Their revised work, universally known as the trade-off theory of capital structure, makes the case that a company's optimal capital structure should be the prudent balance between the tax benefits that are associated with the use of debt capital and the costs associated with the potential for bankruptcy for the company. Perhaps the best way to illustrate the positive impact of financial leverage on a company's financial performance is by providing a simple example. The return on equity, ROE, is a popular fundamental used in measuring the profitability of a business as it compares the profit that a company generates in a fiscal year with the money shareholders have invested. And after all, the goal of every business is to maximize shareholder wealth, and the ROE is the metric of return on shareholders' investment. In the table below, an income statement for company ABC has been generated assuming a capital structure that consists of 100% equity capital. The capital raised was $50 million. Since only equity was issued to raise this amount, the total value of equity is also $50 million. Under this type of structure, the company's ROE is projected to fall between the range of 15.6% and 23.4%, depending on the level of the company's pre-tax earnings. A popular methodology for calculating ROE is the utilization of the DuPont model. In its most simplistic form, the DuPont model establishes a quantitative relationship between net income and equity, where a higher multiple reflects stronger performance. Corporate management tends to measure financial leverage by using short-term liquidity ratios and long-term capitalization or solvency ratios. As the name implies, these ratios are used to measure the ability of the company to meet its short-term obligations. Two of the most utilized short-term liquidity ratios are the current ratio and acid test ratio. Both of these ratios compare the company's current assets to its current liabilities. However, while the current ratio provides an aggregated risk metric, the acid test ratio provides a better assessment of the composition of the company's current assets for purposes of meeting its current liability obligations, since it excludes inventory from current assets. Many quantitative and qualitative factors need to be taken into account when establishing a company's capital structure. First, from the standpoint of sales, a company that exhibits high and relatively stable sales activity is in a better position to utilize financial leverage as compared to a company that has lower and more volatile sales. Second, in terms of business risk, a company with less operating leverage tends to be able to take on more financial leverage than a company with a high degree of operating leverage. Third, in terms of growth, faster-growing companies are likely to rely more heavily on the use of financial leverage because these types of companies tend to need more capital at their disposal than their slow-growth counterparts. Fourth, from the standpoint of taxes, a company that is in a higher tax bracket tends to utilize more debt to take advantage of the interest tax shield benefits. Fifth, a less profitable company tends to use more financial leverage because a less profitable company is typically not in a strong enough position to finance its business operations from internally generated funds. The capital structure decision can also be addressed by looking at a host of internal and external factors. First, from the standpoint of management, companies that are run by aggressive leaders tend to use more financial leverage. In this respect, their purpose for using financial leverage is not only to increase the performance of the company, but also to help ensure their control of the company. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.